Right now, we're going to turn to charting futures. Here's Abigail Doolittle. And Abigail, we're seeing quite a reaction across the asset classes to Powell's congressional testimony.
You're absolutely right about that, Romaine. Let's break it down through the futures market for the most part. A dovish reaction to Fed Chair Powell's testimony to Congress. You see the S&P 500 futures up 0.5%. The Bloomberg Commodity Index, another silo of the risk assets, which tend to be very sensitive to Fed accommodation, up 1.8%. A huge day for the commodity complex. A piece of that, the gold futures up 1.2%. And gold, of course, is seen as a hedge against accommodation and future inflation. So that's another dovish sign. And finally, take a look at the dollar, down 0.4%. The idea is if the Fed is lowering rates, it's not going to support the dollar. So we see the dollar weaker. Now, let's take a closer look at gold and rates, because that, of course, is probably the biggest piece of Fed policy. This goes back to 2009, out of the financial crisis. In white, we've got the 10-year yield. In gold, we have, in yellow, we have gold. And on that accommodation, we have the 10-year yield going down, gold going up to its nominal peak of above $19,000 per troy ounce. Again, hedging against the possibility of future accommodation. And then we see both kind of coming in here. Another period back in 2016 where rates came down, gold going higher. That was also true last year. Take a look at this divergence right now. Gold recently, lots of folks talking about the breakout above 14,000. 1,400. Thinking about Bitcoin for a minute. Will it last? The 10-year yield may suggest, as it finds support there, if this inverse relationship remains in play, that gold is going to drop and rates are going to go higher. To talk more about this and Treasury notes and how to trade them, I'd like to bring in JC O'Hara of MKM Partners. And JC, what do you think? You think that we're going to see this bounce in yields, back up in yields, I should say, and it might be pressuring on gold?
Well, you said gold has been extremely strong recently, and I think the strength caught a lot of investors by surprise, but I think they kind of caught up to the strength in gold. And similarly, yields have been extremely weak, and I kind of think a lot of already is baked into yields.
Yeah.
So that bounce scenario kind of seems to be picking up steam.
It's interesting they're talking about that because we've seen the 10-year yield fall more than 1%. So no matter what the Fed does, and the fact that it's still higher since that jobs report suggests that policy is priced in no matter what it is. And
yes.
As for your trade on Treasuries, this is a very compelling chart. So this is actually the price of Treasury note futures.
Yes, it is.
A weekly chart going back, or actually a daily chart going back to the financial crisis.
That's right. And what's interesting here is the trade we're suggesting is shorting 10-year futures. And this is not a trade for the weak of heart. And I say that because we're in a very, very strong uptrend here. Right?
That is.
But a lot of times you become too strong and you become too stretched from its average, so you do see a mean reversion. And if we look back again to the financial crisis in 2010, we've seen times when the treasuries have become so strong that you kind of lose that who's the next incremental buyer. And I think we're kind of approaching the time where we should see at least a little bit of softness in treasuries. So that's why the trade we're suggesting is to short Treasury futures here.
Okay, and it looks like there's two key levels there, 122 and 118.
Yes, and these are recent consolidation zones as well as prior lows. So 122, we think that makes a pretty good, compelling target. If we really want to get, I don't want to get too far over the skis, but if we really want to become aggressive, we could set a 118 target.
Okay, yes, that would be very aggressive,
yes.
Certainly. And supporting this view, if we take a look here at your chart with the 200-day moving average well extended above it.
Yes, and so this is one way we measure, like how stretched are you? And when we come this far above, and currently we're right around 4.5% above the 200-day moving average, historically, we've seen that reversion or the mean reversion trade take place. And that's when you pull back to the 200-day. So again, that's support of that 122, which is right where the 200-day is.